Hello everyone, welcome back. In this lesson, I want to talk about something very important. The risk of funding rate arbitrage, and more importantly, how we can reduce those risks. I know many of you feel very excited about this strategy. A stable return of over 30% a year and do nearly nothing sounds amazing, right? Some of you may even start dreaming about becoming rich very soon, or wonder whether you should put all of your money into this strategy. But the answer is no. Funding rate arbitrage is simply one investment tool among many traditional tools we already know, such as buying stocks and holding long-term, fixed time deposits, property investment, ETFs, options trading, and U.S. government bonds. Every single investment tool has its own advantages and its own risks. Let me give you a few examples. Fixed time deposits feel extremely safe, but the return is extremely low. Right now, the interest rate is only around 3% per year. Yes, your money is safe, but you need a huge amount of capital to produce any meaningful passive income. And after inflation, which is around 5%, you are actually losing purchasing power. Actually, you are giving up your opportunity to bank, and they can earn much higher than you do, just take a little more risk. Property investment sounds attractive too. If you use mortgage properly, you can double the capital, but it also comes with huge uncertainties. If you rent to a bad tenant, or you accidentally buy in a poor location, or the neighborhood declines over time, your property value can drop. Not to mention the unexpected maintenance costs, management fees, renovations, and taxes. After all that, your real rental return might only be 2% a year. So the reality is this: every investment tool has rewards, and every investment tool carries risks. There is no such thing as a zero-risk investment. What we should do is simple: understand the risks clearly, and allocate our capital smartly across different tools. Allocation is the key. Let's imagine you have $1 million. If you put all of it into a fixed deposit, yes, you are safe, but you only earn 3% a year, and that doesn't even cover inflation. You also lose the opportunity to grow your capital through higher return tools. On the other hand, if you gamble $1 million on spot crypto trading, picking any coin you like, you might lose 70% in a single year, just like what happened in 2025. Most people simply buy at the wrong time and hope it magically bounces back. Timing is everything in trading, and most people don't have the knowledge or discipline. What about starting a business? Before I began trading, I used to run a small business, and honestly, the risk was even higher. You need to spend heavily on advertising, office rent, staff salaries, insurance, facing competition, changing customer demand, and tax. After all that effort and stress, many years still ended with very little profit, and sometimes even losses. So when you compare that level of risk with what we are doing in funding rate arbitrage, a controlled delta neutral strategy, you start to realize something. If you are willing to take that much risk for running a business, why not take a similar level of risk, but aim for a much higher return? If you do not want to take any risk, time deposit saving is the only thing suitable to you. But you should be careful that bank may shut down without any notice. Funding rate arbitrage is simply a new investment tool within the world of decentralized finance, or what we call DeFi. The main idea behind DeFi is decentralization. No middleman, no bank, no approval needed. Apart from funding rate arbitrage, there are many other DeFi opportunities. For example, you can lend your crypto to other users on platforms such as Aave.com. But the yield for lending USDT is usually around 5% only, much lower than arbitrage. So, why do we still need to talk about risk? Because nothing in the world of investing is completely risk-free. And the key to long-term success is capital allocation. One of the biggest risks in funding rate arbitrage is something called exchange collapse. This means the exchange shuts down suddenly and all the coins you kept inside that exchange may be gone forever. Earlier in this course, we talked about the golden rule. Not your key, not your coin. When you put your crypto on an exchange, you're trusting the platform to safeguard your money. And yes, sometimes things go wrong. For example, in 2022, one of the largest exchanges at the time, FTX, went bankrupt. Investors lost billions of dollars overnight. In other cases, exchanges were hacked and customers' assets were stolen with no compensation. This happens because the crypto world is still very new. And compared to traditional finance, it is less mature and less regulated. So the important question is, how do we minimize the risk of exchange collapse? And the answer is, again, capital allocation. Let's imagine you put all your money into funding rate arbitrage. If one exchange collapses, you instantly lose half your capital. That's devastating. But what if you only invest 10% of your total wealth? If an exchange collapses, you lose just 5% of your total portfolio. That's painful, but manageable. And here's something even more powerful. If your ROI is around 30% per year, you only need about 3.5 years to double your initial investment. If you withdraw your original capital at that point, all the future income you earn becomes risk-free because it's generated entirely from your profits, not your initial capital. In a later lesson, I'm also going to show you how to withdraw and actually use your funding rate income. You don't need to wait 3 years before taking any money out. In fact, if you withdraw your earnings consistently, for example, every week or every month, you're gradually pulling your capital back into your own hands. And when you do this, something very important happens. Your exchange collapse risk keeps shrinking because each time you withdraw a portion of your profit, the amount of money you're leaving inside the exchange becomes smaller. Eventually, even if the exchange collapses one day, you've already taken back a big part of your capital. So the damage is much less. This means you can enjoy the benefits of funding rate arbitrage, you can use your profits in real life, and at the same time, you're steadily lowering your risk exposure. We will go through the exact steps, the timing, and the safest withdrawal methods in a future lesson. In my own portfolio, the maximum amount I put into funding rate arbitrage is no more than 5%. After around 3 years, often even less, that 5% becomes a free cash cow. Even if the exchange collapses at that point, it no longer affects my core capital. For the remaining 95% of my portfolio, I diversify across crypto, bonds, stocks, property, and even time deposits. Each tool has its role, and each has its own risk level. There's another way to reduce exchange collapse risk. Use more than 2 exchanges. For example, you could register on 4 exchanges and split your arbitrage trades across them. If one exchange collapses, your loss is only 1/4 of your arbitrage capital. Finally, let me mention something important, your age. Young people have more room to take risk. If you're young, unmarried, with no children yet, you have time to rebuild capital if things go wrong. So having 50% of your portfolio in crypto might be acceptable. But for someone older or someone supporting a family, that level of risk might be far too high. I hope this lesson gives you a clear understanding of how to think about allocation, how to manage the real risks, and how to protect your long-term wealth, while still enjoying the benefits of funding rate arbitrage.